So joining us now is Torsten Slok, Chief Economist at Apollo Global Management. Torsten, great to have you back on the show right now. And we keep hearing about how cataclysmic a default would be, not only for the U.S. economy, but for the world writ large, and how even if we do get a deal, the uncertainty is not particularly good for confidence and good for growth. How are you factoring it in? How are you modeling it right now?
Oh, it's a very important question. I mean, we already have a backdrop of the Fed is trying to slow the economy down to try to get inflation back to 2%. So it's just an event risk in the short term that comes on the back of an already slowing employment picture, slowing in consumption, slowing down in capex spending. So the broader macroeconomic picture is certainly moving towards a recession. So with that backdrop, this debate is certainly very important and, of course, something that's very critical as we think about where markets are heading.
So when you talk about towards a recession, just looking at your notes here, you talk about a non-recession recession. What does that mean?
Yeah, so that means that for 15 years after 2008, we basically had that the Fed and monetary policy globally was printing a lot of money that basically inflated asset prices. But unfortunately for the Fed and for central banks globally, that increase in asset prices really didn't do much to global GDP growth. So what we should expect now when the Fed is raising rates and the Fed is trying to withdraw liquidity is that the main correction will probably mainly be in asset prices. There is probably going to be a very limited correction in the real economy. So that's also why we should expect that the economic impact of the Fed hiking rates is taking quite some time, partly because of high savings, but also because it's going to take some time before we need that correction in asset markets first. So the short answer to your question, Morgan, is that given that QE had such a significant impact on asset prices, we should also expect that QT and liquidity withdrawal is mainly going to have an impact on asset prices in the opposite direction.
Torsten, I'm concerned that this is taking a long time, as you said, but then it could happen all at once, a kind of unraveling in the slowdown, because we have historically high employment levels supporting what seems to be historically high levels of indebtedness in consumers. And if employment drops to a certain level and they can't maintain that level of indebtedness, what happens? Have you modeled that at all? Where are the employment levels and what could possibly happen if that starts to unravel?
Yeah, no, that's very important. I mean, it's just stepping back. The whole reason why where we are at the moment is for the following, namely that we, during COVID, spent $5 trillion on the fiscal side. And on the monetary side, there was also about $5 trillion spent. That means that the economy got so much of a tailwind with $10 trillion in stimulus. And in very plain words, what's being done at the moment is that the Fed is trying to withdraw that $10 trillion because that $10 trillion created a lot of inflation. And that's the challenge as we look at it today. Namely, it's apparently taking longer time to get that $10 trillion back out of the economy. So the consequence of that is that employment is still strong. Inflation is still elevated. Wage growth is still relatively strong. And all that means that we probably still have, according to some Fed working papers, a few more quarters of savings left before we will get the economy to ultimately begin to slow down. And that's what a non-recession recession means, that it's going to take quite some time before all the stimulus that was thrown at the economy is going to be out of the system again.
But
so that's why the Fed will keep rates elevated.
Is a non-recession recession actually more difficult to come by because this is like a big domino setup where if you knock one, I mean, that's my question anyway, because the high employment is supporting these high levels of indebtedness and you have higher rates that are putting pressure, right, on that consumer all at the same time. How does it unravel slowly and safely?
Yeah, and you're exactly spot on. I mean, the whole problem is that so much money was thrown at the economy during the pandemic, and getting that out now is taking time. So as you're saying, even if debt levels are higher, even if interest rates are going up, the reason why consumption is still doing well is because people still have jobs. Wage growth is still relatively high. And all that means that, therefore, it's just simply taking longer time than anyone expected. Over the last 6 months, the consensus has been saying, oh, the wolf is coming, we'll have a recession. And we still haven't had that recession. And even now, it looks like the recession is being pushed out further. Not even in Q3 now, it may be only in Q4. So the conclusion now is that taking all that money away is going to take some time, and it does, therefore, when we go through that time, make sense that markets have been trading relatively well. So that's why markets are taking its cue from earnings that still are holding up quite nicely, because it's taking so much time to get all the money out of the system.